Thank you for watching the short Val show live.
All right, and thank you. I couldn't have said it better myself. As we head into this afternoon trading day, I wanted to do something a little bit different than what I usually do, and actually come on with some other type of trades in UVXY. Now, these are going to be a little bit riskier than what we usually put up. These are not limited risk trades. These have unlimited risk, and thus what they are is they're trades that have a very high probability of success. But essentially, if we spike like we did a month ago, if we happen to we wake up tomorrow, there's a huge black swan event. You're not going to do well on these trades. They're going to be the equivalent of being actually short shares of UVXY. However, they are high probability of success and possibly an option for you to make money. Now, once again, if you put one of these trades on and you lose money on it, don't come back to me because I didn't tell you to do it. All right. All disclaimers aside, let's take a look at some of this stuff. And we're going to go to UVXY here. All right, so as you may or may not know, UVXY is a 1.5 times leveraged volatility product. What it attempts to do is it attempts to move 1.5 times the way VIX futures move. So if the average of the 2 front month VIX futures moves up 10%, then this will attempt to move up 15%. So let's take a look at a recent chart of UVXY, and it's going to look like other volatility products in that as time goes by, it is going to slowly move down. And we can see it's just this big ramp coming down off this big move, right? So it got up to 135 during the spike, and now it's down to 33. So if we look, one of the ideas is to sell out of the money calls, right? So if we look, okay, so UVXY is, once again, as we said, around the $33 range right now. So if we pull up an options screen here, we can see, let's pull up July. So 52 days till expiration, and we have our July options chart up here. And let's see. So I want to switch this to all strikes. And if we look, all right, so the highest out of the money call in July are the 95 calls, right? So if we look at our chart here, pretty unlikely that we get back to 95, right? Let's widen this out so we can see it better. We don't need our time and sale so much, or that. So let's just. So we were up around 95 during the spike, but no other time in a while have we been up around 95. Pretty unlikely that we triple in price, right? Well, somebody's willing to pay you over $1 for this 95 call out in July. Now, why is this? Why are they willing to pay $1? Don't worry about that. No, I'm just kidding. They want to pay $1 to hedge themselves, so that either they can sell something cheaper, or it's a cheap way for them to, they perceive it as they're hedging a long stock portfolio by buying this option. But the thing is, the likelihood is that this option is going to be worthless. The chance that this is going to be, even if there was some sort of spike, the chance that this is still going to be up over 95 in 52 days is close to nothing. In fact, if we look at the delta of the option, this 95 call, it's showing a 12. So it's showing basically a little bit over a 1 in 10 chance that this is over 95 by July. And indeed, if we have some kind of monster spike, if we have let's say, instead of the coronavirus, the Heineken virus shows up, and the Heineken virus is worse than the coronavirus, and we have another spike, then this isn't going to work. But everything else being equal, we're not going to be above 95 in 52 days. So you could sell this call and it's like free money. You know, you put $100 in your pocket over this time. However, it's going to take some capital to sell this call because you're selling a naked call. So if we look and model this in our little model here, well, one way to do it would be just to pull up the trade, right? So if I put this trade in my trading ticket here, and I look, it says buying power effect $1,100 negative. So this is going to cost $1,000. It's going to take away $1,000 in buying power, and that you're going to have that $1,000 on account with the brokerage until this trade comes off, right? And in addition to that, if UVXY starts moving higher towards that 95 strike, let's say tomorrow UVXY goes up to 60. Well, they're going to want more money than just the $1,000 at that point. If this goes up to 60, they're going to want more money. Let's take a look. So if we go to the Analyze tab here, we can kind of check this out. So this was the July 95 call. And what we can do is we can sell one, and then we can look at it in our modeler here. And so we're going to unclick everything except that one call. Then you can see on here, I actually did sell one of these for the account. So if we have this one call, if we look at price slices, it shows us on the far right here, it would cost us $1,200 in buying power to be short one of these calls. Now, what would happen if this stock, if it's not a stock, but we call it stock, it's a shorthand. What would happen if UVXY went to 50? How much would it cost to have this call on? Well, we could type 50 into our little price slicer here, and it will show us how much it would be. Let's see, hold on one second. This isn't working right. Let's see if I can do something like this. I start to roll this up till this is 50. So if this were to go to 50, instead of costing us $1,200 to be short that call, it would cost us $2,000. So essentially the price to be short this would kind of double if we went up 50%, right? So be aware of that if you're selling some of the stuff, that amount that they're going to make you have on account is going to increase as this underlying moves higher. However, so that's the kind of the bad side. The good side is that we don't have to wait the whole 53 days for this trade to be successful. So for example, right now, let's go back to our options screen. So right now, the July 95 call is trading $1.04 bid at $1.11. But let's go to some options that are going to expire sooner than that and see where the Julys are trading on those. So let's go to this, the 19 July option. So these expire in about half the time as the other ones. So if we go up here, it's the 95 calls. So these 95 calls are offered at 35 cents, right? So if you sold them for $1, if you waited 24 days, according to this, you could buy them back for 32 cents, or you could just leave them, right? Or I'm sorry, you could buy them back for 35 cents right now. So the ones in July with 52 days to go are trading about $1.05, $1.06, $1.07 you could sell them for. The ones with only 24 days to go, you could buy back for let's see, 35 cents, right? So they're only a third the value, in that one period of time, the 24 days, they've decreased only a third of their value from before. So this is the kind of trade that, like, of course, it kind of makes sense. The closer we get till expiration, the less likely it is to get that big spike, and thus this becomes worth less and less. So the beauty of this trade is of course that UVXY is 33 now. Now we could get like a mini spike. It could move higher from here. It could go up to 40. Doesn't matter. Your calls you're still gonna make money and be successful on these calls as long as UVXY is below 95 on expiration in July. And that seems pretty likely, like I said, because it would have to triple in value and stay there for this trade not to work. So yes, more risky than other stuff, of course, but a trade that's going to almost guaranteed to make you money. So kind of an interesting concept. Now, when we talk about trades like this, selling naked calls, we can jump around on strikes if we want to. So for example, we might want to pick something that's got more meat on the bone. So let's see some of the other trades that I did a couple of these trades today. So here is something with more meat on the bone. All right, so this is we're at the 19 June expiration, so 24 days from now, and I've picked a June 41 call. Okay, so if we go back to our chart here, right now UVXY is 33. So for this to work out, UVXY has to be below what number? Well, I sold the call for $3. It's the 41 strike. So UVXY has to be below 41 plus 3 equals 44. So right now UVXY is 33. We're going to make money on this one if UVXY is below 44 in 24 days. So less than a month, it just has to stay kind of where it is. In fact, we've got running room of it can go over $10 higher and we'll still max out on this trade. So once again, this is a trade where we sold the June 41 calls, and right now the market's 262 at 284. I sold these for, I believe, $3 earlier today, and just small, just a one lot. So if you were to put this trade on, if you were to sell one of these, it would require you to put aside $1,300 in capital. So if you sell one of these calls, you're actually collecting money, right? If you sell a call, if you sell anything, you collect money, right? So you sell a call, you collect I collected the $3 I sold it for, put that in my pocket. Plus plus my account holds kind of an escrow, an additional $1,200 to guarantee as money against that trade. In case it starts going against me, they've got some of my money locked in to protect against that. However, it's a winner as long as UVXY stays below 41 plus the price that I sold the call for, which is $3, so 44. So I've got $11. As long as UVXY doesn't rally more than $11 in the next 24 days, then this trade's a winner, and I collect $300. So I'm locking up $1,200 for 3 weeks to collect $300. That sounds pretty good, doesn't it? Of course, like I said, this is a risky trade because UVXY could go back up to 135, right? And so if you sell one of these calls, you have to think of it as having sold 100 shares of UVXY, because essentially, as UVXY moves higher and higher, this call is going to give somebody the right to buy UVXY paying 41. That's what a call is. So if we look at our stock chart here, if somebody buys this call from us, if we sell somebody this call, it gives them a right to buy the stock paying 41. Even if stock's 135, they still get to pay 41. So that's kind of the nature of selling a naked call. However, once again, this trade kind of sounds like it sounds like a good deal, right? $300 for that risk, and it's $11 away from occurring. And the other thing is, once again, like I said before, it's not an all or none proposition with these trades, right? If next week UVXY moves a lot lower and all of a sudden you can take this trade off for advantageous prices, then you could take it off right then. Conversely, if something starts to go really wrong and you get cold feet, you could cover this trade. And just to give an example of ways to cover this trade, look at, I'm like a ghost here. I'm like halfway in the screen and halfway out. Woo! 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 If excuse me. For example, the first option trade we did, we were talking about this July 95 call, right? a buck. We were talking about selling for a buck. I think I sold one of these for $1.07. I'm exactly in the way of this right now. Right now the market is 101 bid at 111. Okay. Now there are ways we can protect ourselves. Okay, so that's $100 if this works out, right? But what I did notice was if I go to the front week, I can look up here, and the front week, the 70 calls, those are the 95 calls we sold. The 70 calls are offered at 4 cents, right? So I can pay $4 and protect myself against that short risk for the next few days, and I could sleep very well the next couple days, knowing that that even if there's the the Heineken virus comes in, I'm protected for now by paying 4 cents. So, and actually, this would be a great spread. I'm buying the 70 call, paying 4 cents, and I'm selling the 95 call at $1. So that kind of works on a lot of levels, and I love to do this anytime I have upside risk in UVXY or one of these other issues. I love to look for these cheap bargain like options that are like just a couple pennies, because I'll pay $8 to sleep better at night and know I still have some good trades on next week. And so I bought a couple of these for these 70 calls, paying 4 cents, and lets me sleep well. And at the same time, I'm still collecting money every day. The other thing that I've done with this position here is, I sold some of these out of the money calls. Why not add to our pile of potential cash by selling some out of the money puts too? So, we know that if this is going to run really hard in one direction, it's going to probably be up, right? Markets don't crash up, they crash down, and VIX products don't spike down, they spike up. So if we go a couple months out or a few weeks out, we can sell way out of the money options, way out of the money puts. If it gets down this low, we've still made a lot of money because we're short overall deltas. But by selling some of these way out of the money puts, it adds to like the daily income. So I've kind of crafted together a position here by selling these some of these way out of the money calls and selling way out of the money puts. And the net overall sum of this, I'll show you here, is pretty flat delta, but I'm collecting $56 a day, and right now I'm kind of flat deltas, but as this next week comes off in 3 days, I'll be short deltas again. But it's just a position where we're taking advantage of the fact that these out of the money options are pretty jacked up, and so as long as we kind of stay doing what we're doing, we'll collect a little money here and there. And although we do have some risk as far as like if an extreme event happens, our risk in general is relatively small here. Our delta is relatively small, and it's just another way that you can trade these vol products. If you thought of UVXY, if UVXY were a stock, how about this? If UVXY were a stock, it would be a very high vol stock, right? If we look at the volatility level of UVXY options, 150 vol, right? If you have a stock that's options are 150 vol, that generally is like a stock like right before earnings or something that moves around a whole heck of a lot. And the risk reward of selling this premium seems to be pretty high. So I've selectively picked some little spots to sell here and there. I spread it across different months, and you can look at the trades if you want. You can zoom in and look at the trades here, some of the ones that I've put on. And once again, I'm not advocating that other people do this because it is risky to some extent. If we do have the Volmageddon tomorrow, you're going to have to jump and protect yourself. However, even with all that being said, if I would suggest that you check your risk when you put trades on, obviously all the time. And if we look here at what would happen if, once again, if this was up 50, if UVXY went up 50%, which is a pretty major spike, this position loses $2,000. If UVXY is up 100%, like, and that means like in one session, without me being able to do anything to protect myself, I lose $5,000. So essentially, I would lose a little bit less than half of this account's value if UVXY spikes 100% and stays there till expiration, which is very, very unlikely. But it's good to know what that number is, right? Because you want to know what you're dealing with. The other thing, as I said before, if this were to start moving higher, at some point we would be forced to buy in a couple of the short options or deposit more money, because as it moves higher, it requires more capital to maintain this position. Okay, so there you go. And before we go, I just want to show you a different position that I have been messing around with, and this is in YOLO. And this YOLO thing has been all over the place, and it appears to me that option prices are not, the volatility of the underlying instrument, YOLO, is much higher than the option prices right now. So to me, that means that options out in November are a bargain. So when I've looked on the screen at some options out in November, I've identified some I have interest in. For example, the November 14 calls. I bought a few paying 80 cents. Now, if we look at the chart for this, it came down from 25. Now it's back to 11. It's kind of popped. It's been popping a lot lately. Now it's back to 11. It certainly could get to 14 in the next 6 months. And in the meantime, I am looking to actually buy some put options as well, so that we can participate. If it moves back down to 5, we can make money, and if it moves back, and if it continues to rally higher, we can make money. So I feel that if we're selective about how we put on a position in YOLO, that we can make money coming and going, but just because the option prices are so much cheaper than the amount that this is moving around. And if you look at the individual components of YOLO, the different MJ stocks, a lot of them are in these kind of volatile situations as well. So something you might want to look at as well. And well, I'm kind of like that ghost mode here again. Ooh, here I come back. All right, so there you go. Some option ideas for you. I hope you're doing well, and I will check in with you very shortly again, probably tomorrow morning on the Short Vol Show live. And once again, I would caution you before you put on risk. I don't know what your risk is, but I would caution you about that. It seems like my video has been demonetized. Kind of strange. All right, anyways, that doesn't matter. I'll talk to you later. Bye.